Hello friends, in today's video, let's discuss the definition of current assets and current liabilities as per IFRS. My name is Pratij and welcome to Deep Dive into IFRS. An entity can classify an asset as current asset when it satisfies one of the following four conditions. Number one, when it expects to realize the asset, intends to sell or consume it within its normal operating cycle. Number two, when the asset is primarily held for the purposes of trading. Number three, when the entity expects the asset to realize within 12 months after the end of the reporting period. And finally, number four, it's a cash or cash equivalent which is not restricted from use for at least 12 months after the reporting period. So before I get into the explanation of this definition, let me tell you what operating cycle means. Operating cycle is the time between acquisition of assets for processing and their realization in cash or cash equivalents. That is, suppose you are a manufacturing company. You purchase raw material from your vendor, then do some treatment for that, then get into the production process. Once the production is done, you package the final product, then find a customer, sell it to him, invoice it, and treat him as debtor in your books. And finally, he pays up your invoice amount to settle the dues. So the time taken from the initial purchase of raw material till the debtor pays up, that is what is called the operating cycle. If a normal operating cycle is not identifiable by the management, if it is not clearly identifiable, then it is generally treated as 12 months. What is clearly identifiable or not is up to the management to decide. Now let me get into the explanation of the definition. Let us go part by part. Part 1, the normal operating cycle thing. Suppose you are a manufacturer of a ship or aircraft. To build a ship or an aircraft, or to build a fleet of ships or a fleet of aircraft, it takes several years. At least 2 to 3 years. So from the time you treat customer as debtor till the realization in cash, it will take at least a few months, say 10 to 15 months, just to give you an example. So in this case, the normal operating cycle for you would be 2 to 3 years. Just because it is more than 12 months doesn't mean this debtor should not be classified as current. Debtors, cash, inventory, etc. will always be treated as current assets because of this normal operating cycle concept. But suppose debtor is delaying indefinitely. In such a case, you can still treat him as current assets, but you have to be careful enough to make a provision for bad debts in your books. But if you are giving unfair advantage to a debtor where the credit period given is in violation of your normal operating cycle, in such a case, that debtor has to be moved to non-current assets. Now the second part of the definition. Now this should not be confused with inventories. Inventories is covered in the first part itself. This is primarily meant for financial assets that are defined as per IFRS 9 and current portion of the non-current part of the financial assets. Part 3 of the explanation is self-explanatory. Part 4 deals with cash and cash equivalents. But part 4 excludes FD, bank guarantees, etc. because those are not available for use within a period of 12 months in general. Now, current liabilities. A liability can be treated by the entity as current liability when it satisfies at least one of the four following conditions. Number 1, it is expected to be settled in the entity's normal operating cycle. Number 2, it is primarily held for the purposes of trading. Number 3, it is due to be settled within 12 months after the reporting period. And number 4, the entity does not have an unconditional right to defer settlement for a period of at least 12 months after the end of the reporting period. Now the explanation to the definition of current liabilities. Part 1 mainly covers with expenses payable, your creditors, etc. provided they are settled within, they are expected to be settled within the normal operating cycle. Part 2 deals with financial liabilities as per IFRS 9. Part 3 is self-explanatory. When it comes to Part 4, suppose there is some liabilities, there is some payment to be done by the entity within 12 months after the reporting period, and the decision to make that payment is not up to the entity. That is, whoever has lent money to you has the right to demand payment, and on demand, the liability has to be settled. In such a case, that has to be treated as a current liability. So, this is the explanation with respect to current liabilities and current assets. I hope this video was useful to you guys. Till I see you in my next episode, thank you for your valuable time.